Welcome to our comprehensive AUD USD analysis report covering the period from September 15th to 20th, 2025. I'm your host, and today we'll be diving deep into one of the most volatile weeks for the Australian dollar against the US dollar this year. This analysis is based on data from TradingView, Action Forex, Daily Forex, and Investing Live.
Let's start with the executive summary. The AUD USD experienced significant volatility during this week, reaching a new yearly high of 0.6689 on September 17th before reversing course and closing the week at 0.6593. That's a decline of 0.73% for the week, with a massive 103 pip range. The key catalyst was the Federal Reserve's rate decision on September 17th. While the Fed cut rates by 0.25% as expected, their hawkish tone regarding future cuts caught markets off guard. This led to a surge in U.S. Treasury yields to near 4.15%, strengthening the dollar significantly. Market sentiment is quite interesting here. Retail traders are 73% bearish on AUD/USD, while institutional traders remain 55% bullish. This contrarian indicator often signals potential reversals. The Fear and Greed Index sits at 54, indicating neutral sentiment. Looking at our weekly price action chart, you can see the dramatic story unfold. The pair opened at 0.6647, climbed steadily to reach that yearly high of 0.6689 on Fed Day, then experienced a sharp reversal over the following 3 days. The key performance metrics tell the story. We had a weekly high of 0.6689, a low of 0.6586, giving us that 103 pip range I mentioned. The average daily range was 41 pips, which is considered high volatility for this pair. What's particularly noteworthy is the market characteristics we observed. Strong initial momentum on the Fed rate cut, followed by a sharp reversal on the hawkish commentary. This increased volatility was driven primarily by USD strength, following the Fed's less dovish stance than markets expected. From a technical perspective, the outlook is mixed but leaning bearish in the short term. Our analysis from Action Forex shows that hourly and 6-hour timeframes are displaying a bearish bias, while daily and weekly charts remain neutral to bullish. The key technical levels to watch are resistance at 0.6670 and 0.6620, with critical support at 0.6550. As Daily Forex noted, the pair showed signs of exhaustion after failing to hold above the 0.6700 level, suggesting a move back to that 0.6550 support area. For the medium term, the overall trend structure remains intact despite this recent pullback. However, the 0.6550 support level is absolutely critical. A break below this level could signal a deeper correction, potentially targeting the 0.6400 area. TradingView indicators are showing neutral readings across both oscillators and moving averages, suggesting a period of consolidation. The fundamental picture is dominated by the Federal Reserve's impact. On September 17th, the Fed delivered a 0.25% rate cut, but signaled a more hawkish outlook than markets expected, projecting only one more cut for 2025. This caused US 10-year Treasury yields to surge to 4.15%, attracting capital flows to USD assets. Our dual axis chart shows the inverse relationship between AUD/USD and US yields perfectly, as yields climbed from 4.02% to 4.15% during the week. AUD/USD fell from its high of 0.6689 to 0.6593. The key events that shaped this week included the Fed's hawkish surprise, the subsequent Treasury yield surge, a shift in global risk sentiment from risk-on to cautious, and some market liquidity issues on Friday that amplified price movements. Each of these events had high to medium impact on the currency pair. For trading recommendations, we have both short-term and medium-term strategies. In the short term, we see a 70% probability of continued bearish momentum. The primary strategy is to short on rallies to the 0.6620 resistance level, targeting the 0.6550 support with a stop loss above 0.6670. Alternatively, there's a 30% probability bullish scenario where traders could buy on a confirmed bounce from 0.6550, targeting 0.6670 resistance, with a stop loss below 0.6500. For the medium term, the strategy depends on the critical 0.6550 level. A break below this level would favor a bearish outlook targeting 0.6400, while a hold above 0.6550 could present buying opportunities for a move back towards 0.6800. Risk management is crucial. We recommend a maximum 2% risk per trade with a minimum 1 to 2 risk-reward ratio. Let's discuss risk management and market outlook. We have three main strategies. A primary medium risk strategy with 70% success probability, focusing on long positions at support levels. An alternative high risk strategy with 55% success probability for shorting resistance, and comprehensive risk management rules. The 5 key risk management rules are: maximum 2% position sizing per trade, always use hard stops rather than mental stops, reduce position sizes during high-impact events like Fed meetings, scale out profits at key levels, and monitor correlation risks with the USD index and commodity prices. Looking at our market outlook probability chart, short-term bullish probability is 45%, medium-term is 60%, and long-term extends to 70%. This suggests that while we may see continued weakness in the near term, the longer-term outlook for AUD/USD remains constructive. Thank you for watching this analysis. Please like, subscribe, and hit the notification bell for more Forex analysis. Leave your thoughts on AUD/USD in the comments below, and remember, always trade responsibly and never risk more than you can afford to lose.